Good day, subscribers. Thank you so much for joining me today. I am Jeremy. This is the Financial Education Channel, and today we're talking about the 7 deadly sins of stock market investing. I think this video is very important to do. We're talking about the worst things you can possibly do when you're stock market investing. I have been part of some of these sins of stock market investing and lost great sums of money, unfortunately. I've done some of the things we're going to talk about here today. I've seen others do some of these things, and a lot of these sins are some of the ways that people lose the most amount of money in the stock market. Some of these sins are the ways that people never end up making money in the stock market because they're committing some of these. And some of you guys out there, you might be committing some of these right now. So I think it's very important to talk about. We're going to talk about this, and hopefully this will enlighten you guys on some of the things you definitely want to avoid out there in stock market investing. So let's just go ahead and get right into this, guys. Leave a thumbs up if you enjoy it, and let's talk. So number one deadly sin of them all, in my opinion, is investing in a stock or investing in a sector that you do not fully understand. You do not fully comprehend it. So many times I'll see people investing in a stock or a company that they don't even fully really understand. They might understand a little bit about it. They might know a little bit about that company or the sector it's in, but they don't really fully understand it. When you invest in something, when you give your money to invest in something that you don't fully understand, it's going to be very hard for you to succeed in that investment, because what happens if a hard time comes on that company? What happens if the sector struggles that that company's in? You don't even really understand it fully to the first place. So when you're sticking money towards something that you don't fully understand, that can be very, very harmful. And then what could end up happening is that sector or that company might struggle, stock might go down, you might panic and sell because you never even really fully understood it from the get-go. So if in my cases, when I invest in a company, I fully understand it. This is definitely a sin I never commit. I fully understand every single investment I ever invest in. So then if that investment does go down, which remember, when I first invest in something, no matter who you are, when you first invest in something, there's a 50-50 chance that stock's actually going to go down after you invest in it. There's a 50-50 chance. So 50% of the time, that stock's going to go down after I invest in it. It might go down 2%, 5%, 10%, 20%. We don't know. So if I was never comfortable investing that in the first place, if I didn't know that stock really freaking well, then the chances are I would probably just have sold it, right? So that's the number one sin I see people committing. Investing in a stock, investing in a sector of stocks that they do not fully understand. Make sure you fully understand that stock. Make sure you fully understand the industry it's in, the sector it's in, and then you can go on to invest in it at that point. The number 2 deadly sin of stock market investing is investing based upon what other stocks' opinions are. So based upon Warren Buffett's opinion, based upon my investing, just because I'm investing in a stock doesn't mean someone else should go invest in that stock. Just because I see Warren Buffett, he says buy ABC stock, doesn't mean I should go buy ABC stock. That might be a bad stock. So regardless of who it is, you should not just invest based upon what somebody else thinks. You should invest based upon what you feel, what your opinion is. You don't want to stick the blame on somebody else. You want to stick the blame on yourself if you make a bad investment decision. I see a lot of people, they see somebody on TV, they see somebody here or there, say, oh, they're buying that stock, so therefore I should buy that stock. No, absolutely not. You should buy a stock because you believe in that stock, because you've gone through the fundamentals, because you've looked at that business inside and out, and you feel like, you know what, this is where I want to stick my money. I'm going to make a lot of money over the next couple of years, or whatever your time frame is, if I invest in a stock, guys. I see it so often. I mean, think about, for instance, on this channel, what are the 2 stocks I've been preaching that I'm buying since literally I started the 3 stocks I'm buying series? What are the 2 stocks I've talked about? GoPro and Wynn Resorts. If people would have listened to me as far as, oh, Jeremy's buying GoPro, that should be a good one for me. Guess what? They would have lost a lot of money. Now, on the other hand, of course, Wynn Resorts is a complete opposite story. That stock's up massively. So regardless, and the same thing, I could look at a Warren Buffett, I could say, wow, that stock he's gotten is really up huge. That stock's up really huge. So this next one, that's going to be up huge. And he's had a lot of investment failures over the last few years. You know, you look at the one that comes to mind the most of all of them is Tesco, which is a European retailer. He lost literally billions of dollars on that investment. So no matter who it is, you should never just make your investments just based upon because they're buying a stock. And same thing, if they're selling a stock, doesn't mean you should sell a stock. Make your own investment decisions. Don't just do it because somebody else did it. So that's a really bad sin, guys. Number 3, this is by far my biggest sin I commit, and I commit this sin so often, and I'm ashamed of it. I really am. And this deadly sin is going too heavy into a stock, going too heavy into one stock. I commit this sin so often, guys, and it's a one that I need to really get rid of and quit doing because I do it so often. And it bugs me. And it's just going too heavy into one stock. I've done it so many times. I've been 100% in positions before where I literally every dollar in my account is in one stock. And it's a really bad decision. And it's one of the worst decisions you can make because if that company struggles, then your entire portfolio literally goes down, however much that stock goes down. So I have a lot of trouble with this, and it's a sin that I'm trying to commit less and less, and hopefully not at all in the future. But I've committed it so many times where I've been 80% of my portfolio in a position, 90%, 100%. It's a really bad move. Even if you're so confident on that company is going to succeed, even if you believe so much in that company, just because you believe in that company, just because maybe they report good numbers, doesn't mean that stock's going to go up. A lot of it's going to depend on what the analysts think and do they think that stock should go up. A lot of it's going to depend on the big fund managers. Do the big fund managers believe in that stock? So just because I invest in a stock, I believe in it a lot. Just because that stock maybe does good financially does not mean that stock's going to go up. It could actually go down based upon someone else's opinion that has a lot more weight than mine. My opinion has no weight. I can't move a stock up and down, even regardless of how many subscribers I have on this channel. And analysts, though, shit, they can move that stock up 5-10% in a day or down. So I've gone too heavy in so many stocks over time. There's so many countless ones I can tell you guys, and it's definitely a sin you do not want to commit. You want to be diversified a bit, and you don't ever want to go too heavy into just one stock, regardless on how much you believe in that stock. Number 4, deadly sin in stock market investing is investing on margin. This is one I got caught up into late 2014 into 2015, investing on margin, meaning basically you're taking out loans to invest more money in stocks, hoping that you're going to get the gains you need to get. You also have to pay interest on that margin loans, which I was paying 6-7% on those margin loans. So say I took out a margin loan for $100,000. Over the course of a year, I have to pay $6,000 to $7,000 in margin interest on that. It's a really bad move. I mean, I love Warren Buffett saying, as far as investing on margin, he says, if you're dumb, you have no reason to use it. And if you're smart, you don't need it. If you're smart, you don't need to be investing on margin. And if you're dumb, you have no place in using margin to invest. And I knew that saying forever, and I wish I would have just kept with that saying because I ended up starting to use it, and it was a really bad move because then I began to get short-sighted, some of those kinds of things. I began trying to make fast money, which is something we'll get into in a minute, and it just really screwed me up, and I had to pay thousands upon thousands of dollars in interest. It lost me money in the end because I was investing it too short-term. Don't mess around with margin. No reason to do it, guys. No reason. Number 5. Investing in a company with a poor balance sheet. This is one, thank goodness, I never commit ever. I always invest in companies that have very strong balance sheets, companies that are loaded up on cash, have very little or no debt. So often I see people invest in a company with a balance sheet that is loaded up with debt, has hardly any cash on it and things like that, and then the company falls on hard times, right? Then what ends up happening to that person's investment is going to go down massively because then all of a sudden the worry becomes, could this company face a bankruptcy? Do they need to take out massive amount of loans to cover the business operations right now? You never know when you can invest in a company and it can fall on hard times. I mean, think about you could own the best restaurant stock, right? You could own the best restaurant stock in the world, such a well-run company. If all of a sudden they have an E. coli situation, a big E. coli situation, something like that, it's going to damage the brand massively for multiple years. And it's going to take them a long time to get back from that. They could end up going from a very profitable business to actually unprofitable overnight. We saw that happen with Chipotle, right? Chipotle is such a well-run company, such an amazing company, profitable, all these things. Chipotle investors, overnight, they got killed, but lucky enough, Chipotle had a great balance sheet. Say Chipotle did not have a great balance sheet and they could not have gotten through those hard times. There would have been bankruptcy fears. There would have been all these different fears out there. And Chipotle stock, instead of dropping from $700 to $400, probably would drop from $700 to $100, $700 to $50, something like that. So always make sure you're investing in companies with strong balance sheets, because a recession can come out of nowhere. A company falling on hard times, a failed product, a failed service can come out of nowhere. Sometimes it's just bad luck that happens with that. But guess what? If you invest in a company that has a strong balance sheet, you don't have to stay awake every night and think, oh my gosh, is my company going to go bankrupt? You don't have to do that, guys. Number 6, the 6th deadly sin of stock market investing. Investing in a company that is scared to put itself out of business. What does that mean? There's certain companies out there who are strictly focused on just trying to keep market share, trying to just not expand business, just trying to focus on their one business, and they're not scared to put themselves out of business. They're not scared, or I should say they are scared to try to create new products and services, because they just want to hold up what they have right now. This is actually a great analogy I learned actually from Steve Jobs. You know, he pointed this out with a lot of companies. Steve Jobs, I remember back in the 90s, he did a great interview, and he pointed out on how a lot of companies in Silicon Valley, a lot of tech companies, what will happen is they get a certain amount of market share, right? They get a certain amount of market share in their business, and that's where all their profits come from, and that's where they're a beast. And then they don't really care to start anything new, because they just want to keep that market share. So they don't care to start a new product that might eliminate their old product, right? Because they just want to keep their old product. And what ends up happening is those companies begin to get run by a lot of marketing people, right? And the innovators of that company kind of slowly die off, because they're not important. It's just about keeping this market share at this point. So if you're ever in a company, investing in a company that's afraid to put itself out of business, then that's a bad move. You want to be in companies that are skating to where the puck is, regardless if that's going to take market share from them. I mean, all the time in my businesses, I'm trying to do something that might eliminate my business, right? I'm trying to come up with new products and services that might actually eliminate old products and services. I'll give you an example. For my current business, I just came out with a new product, which is basically, I have one of those Segways. I don't know what you call it. I think you call it a Segway. I bought one of those from Best Buy. It was like $400. And basically what I can do now is, you know, I'm in real estate marketing. I do photos and videos for homes and whatnot. So what I can do now is I can roll around a house, get all smooth shots with my DSLR, which is on like a tripod, not really a tripod, basically like a U-stick type deal. Hold that, go all around the house, and it's like a video virtual tour, right? Well, that kind of eliminates one of my old products, or potentially eliminates, which was a much more intricate process where I'd use sliders, all these different things, all these different fancy tools. So, and this new product's actually cheaper than an old product, but it's important that I do that, because if I'm not willing to try to put myself out of business and try to do something that will create and maybe eliminate an old product or service, somebody else is going to do it. Somebody else is going to think of that idea and say, okay, and then my customers will go with them rather than me, because that's a cheaper alternative that might even be a better idea. A lot of companies are scared to do that to themselves, guys. And they end up getting put out of business. They end up losing market share because somebody else thought of that idea. Somebody else wasn't scared to go out there and execute. They were scared to go out and execute. I see this a lot with blue chip stocks, guys, so watch out for that. If you've got a company that's not really thinking outside the box and trying to expand in those kinds of things, just trying to hold market share, they're going to end up losing market share in the end. I can guarantee you that. Somebody else is going to take that business from them. So, I mean, imagine, let's look at Apple, for instance. Imagine if Apple said, you know what, we're not going to create the iPad. You know why we're not going to create the iPad? Because guess what? Some people are going to end up buying this iPad instead of buying a Mac. That's how Apple could have thought, right? That's how Apple could have thought. That's how Steve Jobs could have thought about things. I don't want to create an iPad, because guess what? That's just going to take market share from the Mac. Because some people like myself, until I started my new businesses and whatnot, I had no need for a Mac. I could just have an iPad. Everything I could pretty much do on a Mac, other than some of the heavy photo stuff and video stuff, as far as surfing the web and a lot of different tools, I can do right on this iPad. Imagine if Apple thought about that. Guess what would have happened? Somebody else would have created this tablet. Somebody else would be selling tens of millions of wannabe iPads per year, rather than Apple doing it. Apple would have lost share in the iPad space and lost share in the Mac space. Imagine if Apple thought, let's not create a 5.5 inch phone, because that might take market share from iPad. Sure enough, it has, because some people will have a 5.5 inch iPhone now, and they're like, I don't really need an iPad, that's big. But guess what? That was a really good move from Apple, because they weren't scared to eliminate another product by a new product. So that's a big thing, guys. I think that's a big thing, and I hope I explained that really well, because I don't want that to go over people's head. I really don't. I hope I explained that to you guys very well. Number 7, the last deadly sin of stock market investing, it's getting cocky and basically getting addicted to quick money. Getting addicted to quick money, it can happen. It's happened to me in the past, where you invest in a stock, and maybe you say you invest $50,000 in a stock all of a sudden, and then all of a sudden, for whatever reason, the next day an analyst says something good about it or something, jumps up 10%, and you make $5,000 in a day, right? That's addictive. It can be very addictive to all of a sudden make quick money. And all of a sudden, if you make $500 the next day actually seems kind of lame. It's like, only made $500 today? That's kind of lame. How can I make some quick money? How can I get going with some other things? And this was how I got caught up in the things, because I was making a lot of money really fast. And all of a sudden I just got addicted to the quick money, and all of a sudden I started playing earnings. I started trying to, okay, I made $10,000 yesterday, let me try to make $20,000 tomorrow. Then I end up losing money, then I try to chase my bets and things like that. Oh my gosh, guys. So be aware that when you have success investing, there's definitely the possibility that you might get cocky, you might get addicted to that quick money, and just say, this sin is staying away from me. I'm not gonna get addicted to this. I'm not gonna get addicted to this quick money and get unfocused on some of those kinds of things, guys. So I hope you enjoyed this today, the 7 deadly sins that I call them in stock market investing. Are you guys committing any of these? Let me know in that comment section. If you're committing any of these right now, I would love to hear from you guys. Like I said, the one I had the biggest struggle with was that number 3, going heavy into one stock, and it's such a bad move, and I get caught into that so much, so often, and I'm trying to get rid of that. That's the one I'm fighting personally the most. Let me know which one you guys are fighting the most. I would love to hear from that. If you just came across this channel, you may want to subscribe. We talk personal finance in the channel. I'm an actual business owner. I give away so many business tips, including that one that was actually number 6, what we talked about. That's actually a big business tip. And then number 3, we talked about the stock market the most of anything. Thank you for watching, guys, and have a great day.